Let's discuss lock-in agreements. In most cases, the terms borrowers are quoted when they shop among lenders only represent the terms available to borrowers settling their loan agreement at the time of quote. The quoted terms may not be the terms available to you at settlement weeks or even months later. Therefore, a borrower should not rely on the terms quoted when shopping for a loan unless a lender is willing to offer written lock-in. A lock-in, which is also referred to as a rate lock or rate commitment, is a lender's promise to hold a certain interest rate and a certain number of points for a borrower, usually for a specified period of time, while his or her loan application is processed. Just for reference, points are additional charges imposed by the lender that are usually prepaid by the consumer at settlement, but sometimes can be financed by adding them to the mortgage amount. 1 point equals 1% of the loan amount. Back to lock-ins. A lock-in that is given when a borrower applies for a loan may be useful because it's likely to take the lender several weeks or longer to prepare, document, and evaluate the loan application. During that time, the cost of mortgages may change. But if the interest rate and points are locked in, a borrower should be protected against increases while his or her application is being processed. This protection could affect whether he or she can afford the mortgage. However, a locked-in rate could also prevent a borrower from taking advantage of price decreases unless the lender is willing to lock in a lower rate that becomes available during this period. It is important to recognize that a lock-in is not the same as a loan commitment, although some loan commitments may contain a lock-in. A loan commitment is the lender's promise to make you a loan in a specific amount at some future time. Generally, a borrower will receive the lender's commitment only after his or her loan application has been approved. This commitment usually will state the loan terms that have been approved, including the loan amount, how long the commitment is valid, and the lender's conditions for making the loan, such as receipt of a satisfactory title insurance policy protecting the lender. Should your lock-in be in writing? Some lenders have pre-printed forms that set out the exact terms of the lock-in agreement. Others may only make an oral lock-in promise on the telephone or at the time of application. Oral agreements can be very difficult to prove in the event of a dispute and offer no guarantee that the current financial terms may be available at a later date. It is wise to use written, rather than verbal, lock-in agreements to make sure that your borrowers fully understand how the lock-ins and loan commitments work, and to have a tangible record of your arrangements with borrowers. This record may be useful in an event of a dispute. It could happen. Let's move on to how long lock-ins are valid for. Usually the lender will promise to hold a certain interest rate and number of points for a given number of days. To take advantage of these terms, a borrower must settle on the loan within the given time period. Lock-ins of 30 to 60 days is common. Some lenders may offer a lock-in for only a short period of time, for example, 7 days after a loan is approved, while other lenders might offer longer lock-ins up to 120 days. Lenders that charge a lock-in fee may charge a higher fee for the longer lock-in period. Usually the longer the period, the greater the fee. The lock-in period should be long enough to allow for settlement and any other contingencies imposed by the lender before the lock-in expires. What happens if the lock-in period expires? If this happens, most lenders will offer the loan based on the prevailing interest rate and points. If market conditions have caused interest rates to rise, most lenders will charge a borrower more for the loan. One reason why some lenders may be unable to offer the lock-in rate after the period expires is that they can no longer sell the loan to investors at the locked-in rate. That agreement may expire around the same time that the lock-in expires, and the lender may be unable to afford or offer the same terms if the market rates have increased. Lenders who do intend to keep the loans they make have more flexibility in those cases where settlement is not reached before the lock-in expires. Please note that in many states, through their adoption of the provisions of the SAFE Act, they have adopted very strict rules for content and disclosures when lock-in agreements are being used. And if you choose to license in different states, you should consult those state laws accordingly.